Hi, I'm Dr. Phil Harris, and welcome to Talking Spreadsheets. I hope you'll enjoy today's session, which is about the weighted average cost of capital. The first thing I want to do is I want to define weighted average cost of capital. And what that is, it's the cost that we have to initiate new projects, and it's based on our mix of debt, equity, and hybrid securities like preferred stock, which is an example. And we take the cost of our existing projects that we've already financed, and then we adjust for the unique risk of the new projects that we're looking at taking on. That rate becomes our discount rate that we use for capital budgeting, and there's different capital cost component methods that can be used. So, it's not necessarily one. It could be a combination of capital asset pricing model, Gordon model, risk premium model, any of those kind of things. So when I'm talking about the complexion, here's what I'm talking about. We have the market value of our capital structure, and our capital structures consist of debt, which is the deep purple, and then we have our hybrid, which is our preferred stock, and our light purple is our common stock. So that's the proportion of each of those things that we have in our capital structure, and then we figure out what the percentage is. So let's look at an example. We have Wingate Corporation, and it has capital cost components on its balance sheet. We have debt, and Wingate issued 1,000 bonds 4 years ago at a coupon rate of 8.25%. The bonds had 20-year terms and $1,000 face values, and now sell to yield 8.75%. The tax rate's 35%. For preferred stock, Wingate has 2,000 shares of preferred shares outstanding, each of which pays an annual dividend of $7.25 a share. The stock originally sold to yield 12% of their $40 face value. The shares now sell to yield 10%. Then we have our equity. Wingate Corp has 120,000 shares of common stock outstanding, currently selling at $13.28 per share. The risk-free rate is 3%. We've got a market rate of 9% and a beta of 1.5. So let's look at a spreadsheet of this, and I'm not going to reread the information at the top because I just read it, obviously, but let's look what's in the cells. What we're calculating first off is our market values. So we have common stock. We had 120,000 shares at $13.28 per share, and that equals 1,553,600. So that's the market value of our common stock. We also have preferred stock. We had 2,000 shares, and we don't know what the market value per share is, but we can calculate it. And the way to do that is to take the $7.25 dividend rate and divide it by the yield. That'll give us $72.50. So if we take $72.50 times 2,000, that gives us our $145,000 market value. Now we come down to the third item here, and we have our cost of debt. And what we do for the cost of debt is we take our yield, which I believe is 875 up in the information that we had for the problem, and that's 8.75%, and we multiply that times 1 minus the tax rate. Why minus the tax rate? Because we get a tax shield for the interest that's attributable to the taxes that we're saving. So we have our three components of capital cost, and then the next thing we have to do is figure out or we should have done it already, um, we have to figure out our cost of debt. And we can do that. If you look down at the bottom, you'll see there's a partial function box. And let me open up a spreadsheet, and we'll calculate it on a spreadsheet just to give you an idea. Okay, so we have a spreadsheet open, and what I'm going to do is put my cursor in a cell, and then I'm going to open the function box, which is this FX up here, and it's going to open another box, and it's asking us for a function to use. And we want to use present value, and you can see it opened right to it. And normally that was just lucky that it happened this time, but normally you're going to have to find it. And you could either type it in up here, or if you want to find where it's at, it will probably be here under the financial functions. I'm not going to do that because it opened right up, but I just wanted to show you how to find it. And then you click OK, and it opens up a function box. And the first thing you have to put in is our market interest rate, which I believe is 0.0875. And actually, let's put that in as a percentage, and I'll show you something else here. You have to put the percentage sign in to put it in as a percentage, and then you see out to the right, it gives it to you in fractional form. And then the next area is for your number of periods. And if you recall, these are 20-year bonds, and we're 4 years in. In other words, we bought these 4 years ago, so we've got to take off the first 4 years, and that gives us, if you look to the right, we're 16 years out before they mature. The next thing is we have to calculate our interest payments. And so we're going to put this in as a minus because these are going to be payments out of our pocket, so it's always a minus. And we have 1,000 bonds times $1,000 face value times the coupon interest rate, which happened to be 0.0825. Okay, so that's the present value of our interest payments. And then down here, we've got to put in our maturity value. This is what we're going to pay at the end of the 16 years. So we've got our $1,000 face value times 1,000 bonds, and we're going to pay $1 million. So if you notice down here, we have $957,788, and we also have the same thing in dollars and cents down here, $957,788. So that's our answer. And when you click OK, it just puts it in a cell. And if you ever want to see it again, you just click on the FX and it brings it back up. So that's how you calculate the bond value. You have two basic components, the present value of the payments and the present value of the value at maturity, which is your future value. So that's that. And let's go back to our slides. And if you recall, there's different methods you can use. There's cost or market value. We happen to use market value because it's more accurate. But you could, if you don't know market values, you could take the cost right off your balance sheet for each of the cost of capital components, debt, equity, and preferred stock in this case. Also, we're going to estimate these using different methods, as we pointed out. And we could use one method, we could use all the methods. And then lastly, we're going to adjust for any unique risks for a project. And that's a whole other topic we can talk about another time. So basically that's it. And I hope you've learned from this, and you'll find the information valuable. And thanks for listening to me, and we'll see you again soon.